The stock markets have been on a wild ride lately, but let's face it, the ride can't go on forever. And it's time to face the harsh reality that a market crash is looming on the horizon. As history shows, crashes are not a matter of if, but when. So it's better to be safe than sorry. And that's why we're here to help you prepare for the impending market crash. In this video, we'll share 10 crucial things you need to do right now to safeguard your investments and come out on top when the market inevitably takes a nosedive. From diversifying your portfolio to having a well-thought-out plan, this video will prepare you to face the storm head on. So let's dive right in. Number 10. Know what you own and why. Investing in the stock market can be a wild ride. It takes a lot of research, a solid understanding of the market, and a bit of gut to succeed. But if you play your cards right, the potential for high returns is definitely there. You should learn very early in your investment journey never to make decisions based solely on fear. For example, if you're experiencing a temporary market slump, it's not necessarily a reason to dump an investment. Instead, take a step back, and reviewing your original stock research notes is essential. Those notes are like a roadmap that guide you through the ups and downs of the market. Your research notes should include all the strengths and weaknesses of each investment in your portfolio and why you chose to invest in them in the first place. The beauty of having these research notes is that they can help you stay level-headed during market downturns. They remind you of the original purpose of each investment and can help you decide if it's time to part ways with a particular stock. This way, you can make decisions based on logic rather than panic. And as history has shown, the stock market always recovers from downturns. By keeping a cool head and solidly understanding each investment, you can ride out the bumps in the road and remain invested for the eventual recovery. Number 9. Understand your risk tolerance before a crash occurs. When it comes to investing, it's essential to know yourself and your risk tolerance. After all, you don't want to lose sleep over your portfolio or make rash decisions that could negatively impact your investments. For example, if you're considering investing in high-growth stocks, it's essential to understand that they can be more volatile and subject to bigger swings in price. If seeing your investment lose 50% of its value would cause you to lose sleep, then high-growth stocks might not be the right choice. But don't worry, investing conservatively doesn't mean you have to give up significant wealth creation. If you look back at the S&P 500 index, which tracks the U.S. stock market, it has delivered an average annual return of 11% since 1980, even with market crashes and corrections. That's some serious wealth creation. So if you're new to investing or just getting started, it might be a good idea to consider a low-cost index fund that tracks the S&P 500 as part of your portfolio. Doing so allows you to participate in the stock market's growth without worrying about picking individual stocks or timing the market. Ultimately, investing is a personal decision, and you must find your best approach. Number 8. Breathe. Recessions happen all the time. If you've ever experienced a market downturn, then you'd agree that it can be pretty scary, especially if you're new to investing. But here's the thing, it's actually a normal part of the process, and it happens more often than you think. In fact, since 1950, the S&P 500 has experienced a double-digit decline about once every 1.87 years. Now, that might sound like a lot, but the good news is that a bull market rally has erased every one of these crashes and corrections. Yep, every single one. And in many cases, it's only taken a few weeks or months for the market to bounce back and put the drops in the rearview mirror for good. Of course, that's not to say that it's easy to watch your investments lose value. It can be tough to keep a level head when you see those numbers going down. But if you can take a breath, stay focused on your goals, and resist the urge to make knee-jerk reactions, you'll be much better off in the long run. Remember, patience and perseverance are the name of the game when it comes to investing. Number 7. Ignore emotion-driven white noise. You know, it's funny how the stock market can be so unpredictable. Even with all the technology and information available today, it's hard to predict when a market crash will happen. But you should know that short-term traders drive the market during these times based more on their emotions than on news or data. It's easy to get swept up in the panic and fear of a market crash, but you can take comfort in the fact that they are usually short-lived. And here's the catch. As scary as market crashes can be, they can also present opportunities for investors willing to stay calm and look for undervalued stocks. It's about keeping your eye on the big picture and not letting short-term emotions dictate your investment strategy. So don't panic or get too caught up in the moment. Remember, that market crashes are a natural part of the investing process, and by staying focused and informed, you can build wealth over time and come out on top. Number 6, have cash ready to take advantage of undervalued stocks. Ever heard the saying, buy low, sell high? Well, it turns out that there's no better time to buy low than during a stock market crash. It might seem counterintuitive, but crashes are actually excellent opportunities to invest in quality stocks at bargain prices. So the next time you hear about a market crash, don't panic. Instead, make sure you have some dry powder ready and get ready to go shopping. You can think of it like a once-a-year sale at your favorite store, but for stocks. And the best part? History has shown that every single crash or correction eventually gets wiped out by a bull market rally. So as long as you're focused on the long term, you're in a great position to make some serious gains. Number 5, avoid margin like the plague. One mistake you should avoid at all costs during a market crash or steep correction as an investor is leveraging your buys with margin. Buying on margin is like taking out a loan to invest in the stock market. It may sound tempting to borrow money to purchase more shares and potentially increase your returns, but it also exposes you to more significant risk. Using margin to amplify gains during a bull market is like using a turbocharger to increase the speed of your car. But when the market turns bearish, it's like hitting a speed bump at full throttle. You risk losing control and crashing. One of the biggest dangers of using a margin is the potential for losses to exceed your initial investment. If your investments decline in value, the broker may issue a margin call, forcing you to deposit more funds to cover the losses. If you can't meet the margin call, the broker may sell your shares to recover their money, locking in your losses. Another problem with leveraging your buys with margin is that it's an attempt to time the market, which is virtually impossible to do with any degree of accuracy over the long run. So during a market crash or steep correction, your focus should remain on your long-term investment goals rather than seeking to use margin to chase short-term gains. Number 4, nibble frequently, as timing the bottom is impossible. Ever wondered when is the right time to buy stocks? When the S&P 500 is crashing or in correction? Thanks to technological advancements in recent years, investing has become more accessible and affordable than ever before. Most brokerages have eliminated their trading commissions, and some even allow investors to buy fractional shares. This means you can easily invest $5,000 into your favorite group of stocks, or just put $5 into a fractional share of Amazon right now. Pretty cool, huh? But here's the thing. We can never predict how steep a market decline will be or how long a crash or correction will last. So instead of trying to time the market perfectly, it's best to nibble frequently when the market dips. Buying stocks in small increments allows you to take advantage of lower prices without risking too much of your portfolio. Number 3, add to your winners. Investing in the stock market can be tricky, but it can also be an exciting way to grow your money. When it comes to investing, it's essential to remember that not all stocks are created equal. Some stocks are winners and others are losers. And if you want to succeed, it's crucial to know when to let go of the losers and when to add to the winners. Winning stocks are usually winners for a reason. They might have innovative products or services, offer unique advantages over their competitors, or have long-term growth prospects that outpace the market or their industry. During times of market panic, many investors tend to sell off all their stocks, even the good ones, in an attempt to cut their losses. But this is not always the best strategy. Instead, it's much wiser to lean on your winners during such times. Adding to your winning stocks increases your chances of thriving when the market rebounds. By adding to your winners and avoiding doubling down on your losing investments, you can position yourself for long-term growth and profitability. Number 2, buy dividend stocks. There's much for you to consider if you're considering investing during a market crash. One option you might not have thought about is dividend stocks. These are publicly traded companies that pay a portion of their profits out to shareholders on a regular basis. Dividend stocks are an excellent choice for several reasons. First, they are typically issued by companies that have been around for a while and have a proven record of generating profits. That means they tend to be more stable than other stocks. One of the significant advantages of dividend stocks is that they tend to perform better over the long term. Another great thing about dividend stocks is that they can provide a steady income stream. If you invest in a dividend stock, you'll receive regular payments from the company in the form of a dividend. This can be a great way to generate income, especially if you're looking for a more stable investment option. But one thing to remember is that not all dividend stocks are created equal. Some companies pay higher dividends than others, and some may be more stable. That's why it's essential to research and choose your investments carefully. Number 1, don't lose sight of value stocks. Value stocks are another smart choice during a market crash or steep correction. The best thing about value stocks is that they're usually profitable companies. Unlike some growth stocks, which may not be profitable, most value stocks generate consistent earnings and cash flow. That means they can provide some much-needed stability during turbulent market conditions. And here's an interesting tidbit. Value stocks tend to outperform growth stocks during the early stages of an economic recovery. That's because these companies are often more established and their stock prices may have already considered any negative economic impacts. So as the economy begins to rebound, investors may have more confidence in these companies' ability to weather any future storms. So if you're thinking about investing during a market downturn, you might want to consider adding some value stocks to your portfolio. Not only could they provide a hedge against market volatility, but they may also offer strong returns as the economy starts to recover. Preparing for a market crash is not something to be taken lightly. By following these 10 steps, you can protect your financial well-being and come out on top, even when the markets are down. Don't wait until it's too late. Start preparing today. Remember, knowledge is power. The more you know, the better off you'll be.